Hello there, it is your host Ishan, and today we have some great stories to share with you today. So let's start off. HSBC has said that they target net zero emissions by 2050, earmarks $1 trillion of green financing. They said they will target net zero carbon emissions across its entire customer base by 2050 at the latest and provide between $750 billion and $1 trillion in financing to help clients make the transition, Chief Executive Noel Quinn told Reuters. The pledge is that the strongest statement made by Europe's biggest bank on global climate change to this point, although it met with criticism from some environmental groups for not taking more immediate action to curb its fuel financing. COVID has been a wake-up call to us all, including me personally. We have seen how fragile the global economy is to a major event, in this case a health event, and it brings home the reality of what a major climate event could do, Quinn told Reuters in a video interview. HSBC aims to realize net zero emissions in its own operations by 2030, he added. While other UK banks like NatWest have already set similar net zero goals, HSBC's aim to attain it across its huge Asia-focused client base is one amongst the foremost significant pledges made by a worldwide lender so far. However, the bank are closely watched for the way, quickly and fully, it pursues its new goals, which are mainly stated as aims instead of hard commitments. It will also face scrutiny on whether it's allowed itself leeway to continue financing some fossil fuel-linked clients, especially in developing markets. HSBC has come under increasing pressure from activists, shareholders, and politicians who say it's contributing to global climate change by financing environmentally harmful projects. Quinn said the bank was focused on expanding its capital market-focused carbon transition policies to a broader one encompassing all its activities across financing, asset management, and company and retail banking. What we have given the market is an ambition that our total financing by 2050 will be net zero. That is a far bigger price or goal than picking a subsegment of our portfolio and saying, I am not going to bank you, because that's not what the world needs, he said. That industry or that customer may then just head to Bank X, Bank Y, or Bank Z. They won't have changed their business model. Critics have said HSBC lagged peers in responding to the climate challenge and risked losing dead-set rivals like BNP Paribas that are ahead on settling carbon reduction targets. This week, Wall Street heavyweight JP Morgan became the most recent bank to expand investment in clean energy and work towards net zero emissions by 2050, in line with the 2015 Paris Agreement on climate. With many Asian clients directly connected to or reliant on the coal sector, from which emissions are a number one contributor to heating, HSBC is in a very relatively tougher position. It gave no detail on plans to tighten its policy on lending to the industry, still a key driver of the many Asian economies in an exceedingly move likely to anger campaigners. Instead, the bank said it might apply a climate lens to financing decisions and would also still take under consideration the unique conditions for our clients across developed and developing economies. Several pressure groups said they were disappointed the bank wasn't taking more immediate action. The very bare minimum would be to right away exclude all companies with coal expansion plans and need others to adopt a coal exit strategy, as BNP Paribas and plenty of more serious banks have already done, said Lucy Pinson, founder and executive at Reclaim Finance. Adam McGibbon, UK energy finance campaigner at Market Forces, said the plan was zero ambition, not net zero ambition. If you want to know what HSBC stance on climate change really is, look at what they fund on their fluffy marketing. Jean-Matt Martin, senior campaign manager at Share Action, said that while welcome, the commitment to net zero by 2050 was becoming the baseline within the banking industry. As Europe's second largest financier of fossil fuels, we urge HSBC to commit to a global coal phase out and take immediate steps to curb its fossil fuel financing. The ramped up financing plans include infrastructure projects equate to a seven-fold increase compared with HSBC's last financing climate pledge of $100 billion made in 2017, with investments making up the rest. To help stakeholders track its journey to net zero, HSBC said it used the Science-Based Paris Agreement Capital Transition Assessment Tool, also known as the PACTA, and would report on progress regularly. In addition, the bank said it worked with peers, central banks, and industry bodies to assist create a globally consistent future-proof standard to live financed emissions and a functioning carbon offset market. HSBC will aim to take a position of $100 million in clean technology and donate an extra $100 million towards climate innovation ventures and renewable energy sources, alongside its previous commitment of funding to a replacement natural capital venture. The next story we have is quite a groundbreaking story. IBM, the 109-year-old company, will be splitting up to focus on cloud growth. They will be splitting themselves into two public companies, capping a years-long effort by the world's first biggest computing firm to diversify far away from its legacy business to concentrate on high-margin cloud computing. IBM will list its IT infrastructure services unit, which provides technical support for 4,600 clients in 115 countries and encompasses a backlog of $60 billion. As a separate company with a brand new name by the beginning of 2021. The new company will have 90,000 employees and its leadership structure are going to be decided during a few months. Chief Financial Officer James Kavanagh told Reuters. IBM, which currently has over 352,000 workers, said it expects to record nearly $5 billion in expenses associated with the separation and operational charges. Investors cheered the surprise move made by Chief Officer Arvind Krishna, the key engineer behind IBM's $34 billion acquisition of cloud company Red Hat last year, sending the company's shares up 7%. We divested networking back in the 90s. We divested PCs back in the 2000s, and we divested semiconductors about 5 years ago because all of them didn't necessarily play into the integrated value proposition, Krishna said on a call with analysts. In a blog, Krishna said the move a significant shift within the 109-year-old company's business model. IBM is essentially getting rid of a shrinking low-margin operation given the cannibalizing impact of automation and cloud, masking stronger growth for the rest of the operation, Wedbush Securities analyst Moshe Katri said. IBM, which has sought to form up for slowing software sales and seasonal demand for its mainframe servers, said it might now specialize in open hybrid cloud and AI solutions, which will account to over half of its recurring revenues. Krishna, who replaced Ginni Rometty as CEO in April, said IBM's software and solutions portfolio would account for the bulk of company revenue after the separation. The company also said it expects third quarter revenue of $17.6 billion and an adjusted profit per share of $2.58, roughly in line with Wall Street estimates. That's it for today. Stay tuned for more episodes. Thank you for tuning in.